Hey everyone, Sean Ryan here from the Ryan Realty Group, and we have Tyler Yates here from the Mortgage Wellness Group. And as promised, we're here. I'm just adjusting the camera so we can see everything. So the purpose today is to try to educate people on common questions we get all the time. And the common question we get all the time is, what's a mortgage broker and what they do? So why don't we have Tyler tell us a little bit about what he does and why is he different? So take it away, Tyler.
Sure. So, good morning, everybody. 11:15. Hopefully you guys can see us. There's not too many shadows in the back there. Now we got this.
Yeah, we got this. Makes us look better, a little bit darker.
So I'm a mortgage broker at the Mortgage Wellness Group here in Sarnia. We work with, our jazz hands say that we work with 72 different lenders. But I think out of our A lenders, we work with about 18. So we take our clients through all different scenarios of down payment, what rate you can get, different term lengths, variable, fixed. We talk about penalties in the event you ever decide to break your mortgage. We talk about prepayments. So we only do mortgages here. So we're not going to talk about investments. We might lightly touch on life insurance to have a conversation piece. But most importantly, we just talk about mortgages. So we try and find the right solution for you, and it gives us an opportunity to find out what is the right solution for yourself. Some people want to pay their mortgage off really quick, some people don't want to pay it off really quick, and then we also strategize for life events coming up too. So we really just try and focus on mortgage stuff and what the best solution is for you.
Awesome, perfect. So we got a couple questions for you here, Tyler. So where can we get a mortgage through? Like, where are places that you offer mortgages to?
Sure. So some of our popular lenders, we work with Scotiabank, and we also work with TD. There's not, you probably don't know of 18 different lenders, but I guess we also work with some mortgage only companies like First National or MCAP, and we would take you through those lenders to know what they're all about. We also have a relationship with our local credit union, Main Street, so we do a good chunk of business with them too. So yeah, we would give you a full range of different lenders that we work with, and you can decide from there.
So you have 72 in total, you said?
We do, yeah. Our brokerage had worked with 72 different lenders last year, but on the A side, really our popular was about 18 that we used last year.
And then so the other lenders would be for like B lenders, C lenders, is that correct?
Yeah, so for individuals that might have credit that might be a bit more challenging, or maybe they're new business owners too, where it's a little bit more difficult to qualify in the traditional ways that you would at your big five banks.
Okay.
There's other lenders too, we would just call them our B lenders, where the rate would be, instead of being 3.5, it might be like 4.5. And after that, you get into some private lender stuff, but we don't really get into that stuff too often here.
So someone will be in that, and then, after a year or so, they can then go to a better lender?
Yeah, our plan is, if it's people that have bad credit,
okay, then
we take them through a financial plan, because it really is 2 years of solid rebuilding, and then we take them out of that B lending landscape and get them into the A stuff. So
perfect.
That's our plan that we put together here for our clients on the B lending side.
So people are always wondering, how do you dictate what they can afford? So how do you say, you can afford this, or this could be your budget? How do you guys do that? Just walk us through that really quick.
So affordability is a little bit different than what you qualify for. So you have to have conversations of are there kids on the way? If there are kids in the way, what are we looking at for daycare too? Because that stuff doesn't go into a mortgage application. So you might be able to qualify for a mortgage, but if you throw $1,000 per month in that mortgage application, that totally changes qualification. So that's a really good question, because affordability is a huge component that we cover here. I'll show you what you qualify for, but I'll really give you the slap in the face of, do you find this payment to be comfortable? And if you do, then we know we're in the right landscape.
Awesome. Hey Carla, how you doing? Thanks for watching. So how does a mortgage application work? Kind of walk us through really quick what the steps are to do that.
So the real basics are, credit comes first, then income comes next. So if your credit's not great, then we can't even look at someone's income. So I guess a really good tip with credit, just because I have an opportunity to do this now.
Yeah, go ahead.
35% of your credit score is weighted towards how well you make your payments on time. So month in, month out, you're making your payments. But right behind that 35% is at 30%, how close is your balance to your limit. So say you've got a $5,000 credit card, but every month you have that thing at $4,500. It makes it look like you're leaning on your credit card to live your day-to-day life. And that actually is really darn close to being the same as missing a payment. So credit comes first, then we get to income, and we go through the qualification, and then also have the affordability conversation here.
So here's a great question we're getting.
Okay.
How soon before I buy should I come speak with you to speak to a mortgage broker?
Ooh, good question.
For a real estate standpoint, first, before you look at any houses, come talk to a mortgage broker and get pre-approved. I guess.
Sure.
Yeah.
I mean, knowledge is power. So even if this was on your radar in 2 years, there's nothing wrong with coming in here and having these conversations. Our government constantly makes changes, so you might find that when we talked about this 2 years ago, that has changed a little bit in terms of qualification. But it doesn't hurt to get in here soon. I mean, we find that like January, people start popping in here to plan for if it's in the next 30 days or if it's going to be sometime in the next year. So really, it's up to you. We always say that knowledge is power, so make an appointment whenever you feel like you want.
So a great point too is, so they'll come in, they're not ready to buy for another year, but you can put them on the right steps to get their credit rebuilt, rehabilitation, so they will be ready in a year.
For sure. And sometimes it's not even about credit either. Yeah. It's more conversations of employment too. Because maybe someone's just on contract work right now, and then you have to tell them, like, this is what we're going to need to look for when you do apply for a mortgage, when you find that perfect house for yourself. So we even strategize people's employment to what it needs to be at the time they do try to apply.
Oh, great. So for down payments, how does that work for people? Like, people need 5%, 20% down. Kind of walk us through the difference between maybe putting 5 down and like 25 or 20.
Sure. So you're considered high risk if your down payment is less than 20%, and CMHC is kind of the Kleenex of the mortgage default insurers. There's 3 different insurers, but everyone knows about CMHC. So if your down payment is less than 20%, then you require CMHC. To get your foot in the door, you need to have a 5% down payment. You also need to, I guess a good rule of thumb is 1.5% of what you're buying your house for is what you should also have saved up for closing costs.
Okay.
So it's your legal costs. You also pay provincial sales tax on your CMHC. So some people want to know those details, but we want to make it really basic. We just tell them you need to have 6.5% of what you're buying the house for, and that will be enough for your down payment and closing costs.
Okay, awesome. Perfect.
Cool.
So that's just a quick summary. So if you want more, obviously reach out for Tyler. Hey, Michelle. Hey, Fabian. Thanks for watching. So here's the difference question. What's the difference between a fixed and a variable rate mortgage?
So a fixed rate mortgage, that will be the same interest that will be applied to your mortgage the entire term length that you choose. So you choose to do a 2-year or up to a 10-year fix, that'll always be your interest rate, which means that your payments will remain the same. If you're in a variable rate mortgage, then that goes based on what your bank's prime rate is, which in hand goes with the Bank of Canada's interest rates too. We've also seen some lenders where they kind of move their prime rate a little bit different, but what I guess the basis of the question that I can answer is that your mortgage payment will change if you are in a variable rate mortgage. There are some lenders that don't make you increase your payment where you kind of actually fall behind. So it's important that you do stay up to speed when you get those letters in the mail saying your rate's gone up. You might want to increase your payment if you have a variable rate where they don't move your payment up. I guess one thing that we do here real quick, if you're going to talk about variable and fixed.
Yeah, sure.
When people are interested in doing the variable, we do show them what their payment would be if they chose fixed. And we try to push our clients in a way to make their payments as if they are in a fixed. Mm-hmm. So even when they see those increases in rate, then they actually don't get to feel that sting of that 0.25% increase, because they're already making enough on their mortgage payment to cover the new interest rate increases. So that's kind of the guiding and teaching that we do here to make sure that you're not like, holy cow, interest rates went up, how's this going to impact me? You won't feel that pain if you're already making those payments greater than what they should be.
So again, it all comes down to the knowledge. So Fabian here, we got a question. Any leeway on down payments for rental properties? Hey, Laura, thanks for tuning in. So I guess the question is...
exactly what it is.
Rental properties, down payments, how's that work? And leeway...
We're starting to find that that lenders are starting to change their down payment qualifications, Fabian. Like, we're starting to find that they want more down. So the times where it used to be 20% was what got you started. We started to find that some of them are now 25%, if not 35%, and also have tiered it on credit score. So it's super important to keep your credit strong, because even if your credit is, say, below 720, you might not be able to get a house or buy a rental property with the down payment you were looking for. So that's where it's good to go to see a broker too, because you might be told that it's 35% down at whatever branch or whatever bank you go to. But here we can take your app and find out, you know what, you actually do qualify for 20% down on your rental property. Does that answer your question, Fabian?
So the last mortgage changes that came through a couple of months ago, were those geared towards second home owners and rental properties? When they changed the they changed the...
So they changed the qualification
Yeah.
rate on conventional mortgages, they changed the qualification rate on high ratio, so CMHC insured mortgages the year previous.
Okay.
So they just did a stress test now on conventional stuff. So if you're going to refinance your house, they're not checking to see if you can afford payments at 3.5. They're now checking to see if you can make your payments if it's based on 5.5. But that was like the next step. So they went insured mortgages first in 2016.
Okay.
2017 they started going after your conventional.
Yeah.
And I'm gonna guess the next spot the government goes after would be more rental properties.
So what about, that's for rental property, what about vacation homes or like secondary homes? Same thing, same rules?
You can still purchase a vacation home with as little as 5% down. It's assuming that you're going to be occupying that space at some point in time. That's what it's based on, because the insurers will only insure properties that you're going to be occupying. If it's clear that you're going to be renting that place out, then yeah, you're going to walk into subject for like rental down payment terms.
So would that be the same, say, if I was buying a house to house a parent or a caretaker for parents?
No. So if it's immediate family, great question.
Yeah.
If it's immediate family, then you can buy a house with less than 20% down. We have found some lenders that I don't know, they put their nose up a bit and start sniffing a little bit more to find out, is this going to be a rental property? So some of them have terms in there that they need to know this thing's going to be rented or occupied by a family member for 12 months. And some lenders don't have that, but you can still buy a second home as long as immediate family member is going to be occupying.
And that's only for single family homes, right? If it's a multifamily, it goes right back up to the original rules, or
no. If you're in a unit, like if it's a fourplex, if one of the family members is going to occupy it, you could get that place with a down payment less than 20%. But then the question becomes, do you want to put your mother in a fourplex? So that's where insurers ask those questions.
Okay.
And if they deem it to be like, yep, this makes sense, good character with this individual, they don't own 5 other properties, it just has to make sense. That's all.
And so if someone was going to ask, what's the big difference between you and a traditional bank?
I think what we found here is that it's just knowledge. Like we're very transparent here. We're not going to turn the screen around, but we have the big screen here that everyone gets to look at. We get to review all the different lenders. You get to actually know the fine print of what you would have signed at your Big 5 bank.
Okay.
We take you through that stuff. And when people leave here and say, I've got an appointment at my bank after this, I always challenge them with like questions to ask their branch rep when they go there to find out if they actually know that information.
So you're not just selling one product to someone. So when you do an approval for someone, are you essentially giving them a couple different options to go with after?
Totally.
Saying like, here's bank A, B, C, or lender. This is what a mortgage looks like after. So give us a couple different options there of why we have those 3 choices and what could be the big differences between the 3.
Yeah, so we talk about prepayments. For first-time homebuyers, prepayments aren't really that important that we're finding from the data that we've collected. I think one cool part is that people will do purchase plus improvements where you can wrap your improvements into your mortgage, and some lenders are really strict on how those purchase plus improvements are done, and some lenders are a little bit more relaxed on it. So depending on if you've got a contractor to do the work or if you have someone who's really good at doing this work too, some lenders want it to be the contractor, some people are okay if it's professional work that's being completed.
So get back you up for a second there. Purchase plus improvements, what is that?
So purchase plus improvements is, say you buy a house for $200,000. You're allowed to add up to $40,000 onto that mortgage as long as it doesn't go over 20% of what you purchased it for.
Okay.
So if you bought for $100,000, you can't go to 40. You can only add $20,000. But that's if you wanted to update your kitchen or update your bathroom or flooring or windows or whatever. You'd have to get contractor quotes to say what the cost is to do this. And then the insurance company or the lender will do some homework to find out if you do add that $20,000 kitchen to your house, is your house now worth $220,000? And if it is, they allow you to do it.
So don't be afraid of those fixer-uppers if you don't have the extra cash, because we can get it tacked right off the mortgage.
You shouldn't be afraid of it. I mean, even if you have a condition of finance where you get to do some homework to find out if you do add $25,000 of value to the house, does it actually go up in that value? Because you might learn during that condition of finance period that if you wanted to put that beautiful $40,000 kitchen in there, it only adds $20,000 of value. That rarely happens. Like, if you're doing stuff to your kitchen, it's going to work. Just don't put a $40,000 fence up. You're not going to add value that way.
I'm seeing more and more people take advantage of the purchase plus improvement, especially the market's been a little busy. When the really nice homes I find are going like multiple offers, huge over asking. When sometimes the homes are a bit more in need of work, aren't going as crazy.
Right.
So I'm seeing a lot more people taking
For sure.
advantage of that.
And some lenders make it that it's 90 days you have to have that work done. Some other lenders are totally cool if it takes you longer than 90 days. So that's kind of the stuff that we go through here in the spreadsheet. It might not even be like you get to choose. We get to know what you're looking to do. So we kind of now guide you down the path of like, this is the lender you're going to want to work with. And also this is how they work. So you know what you're signing up for.
So for people to use you, what's the cost normally?
There is no cost to use our fee here if you're an A borrower. If you're in the B lending landscape, which is about 5% of our book,
Okay.
there is a fee for us for you to use our service in the B lending landscape.
And that will vary depending on the situation.
Correct, because we're paid a commission based on whatever lender you decide to take your business to. So it doesn't cost the A lender anything,
Okay.
or the A borrower anything. Yes, is my commission based into their interest rate? It totally is, but it's just the same as you going to a bank and being offered that interest rate. But yeah, on the B lending side, that's where we would charge a fee to make up the gap of what we would normally get paid on the A lending side.
Okay.
So our time's still worth something,
Yeah,
right?
100%. Yeah.
So, but yeah, it's not a big component of what we do at our business, but we do offer those solutions.
Oh, great. So then you can switch them over into that. So Tyler, how do people get a hold of you if they want to get more information or reach out to you?
Sure. So our phone number is 519-704-1230. I guess if you're watching this thing on Facebook, maybe you've already trolled over to our Facebook site. I got to do a little bit more work on my Instagram.
What's your website?
It's mortgagesarnia.com. Yeah, all of our contact info is on there. So you're able to, you actually can send a message to our website, which our team will get to here if it's Celia, Nicole, or Angel, and we can help you out and then book a time for you to get in here.
Awesome, perfect. Well, thanks everyone for watching. Feel free, if you have any more questions, to write into the comment section, and I'm sure we'll get those over to Tyler and get those back to you. But if you have really more questions, the best thing to do is reach out for Tyler, set up an appointment for consultation. Even if you have a mortgage and it's coming in for renewal, that's something great they can help you with as well. So thanks everyone. Thanks
Thank you,
Tyler
Sean.
for coming on and doing this.
Appreciate it, man.
And cheers everyone. Have a great day.
Yep. See you guys.
Bye.